All right, Matt, the mortgage guy here. And in today's video, I'm going to talk about, should I do a cash out refinance? A super popular question in 2021. People have more equity than ever, more tappable equity than ever. I'll talk about what tappable equity is, and I'll talk about the pros and cons of a cash out refinance, what scenarios I think make sense, when you should, when you shouldn't, and just give my honest feedback on the conversations I'm having with clients in case you're considering a cash out refi. Before I get into it, do me a huge favor. Tap that little likey button for the YouTube algorithm. I appreciate it a lot. Share, comment, like, tell me what you think about cash out refinance. I don't even have to ask that question, and people automatically who disagree with cash out refinance, no matter what the scenario, are gonna get in the comments and say, oh my gosh, Matt, I can't believe you're telling people to cash out refinance their house. It's so risky. You're getting them into trouble. You're having them over leverage. You're the worst thing in the world. You're a mortgage broker. Dislike, thumbs down, disapprove, whatever. Thanks for your opinion. It's your opinion and you're entitled to it, whatever you like. But this is my opinion as a mortgage broker, the folks I'm talking to. And this subject actually came up because I was watching a Black Knight video this morning. They come out with data on a monthly basis. They call it their mortgage market update or something to that effect. And it's really cool and interesting data. And here's a piece of data for you. In Q1 of 2021, 800 billion is the number of gained tappable equity. And when you say tappable equity, what tappable equity is, if you own a house that's worth $400,000, most lenders are going to go up to 80% loan to value, meaning they're going to go up to a $320,000 loan amount. So if you have a $200,000 balance and it's worth 400, but you can go a loan up to 320, that $120,000 spread between what you owe and your max loan amount, that's tappable equity. So as you can imagine, as home prices increase, they go up, in the first quarter, what might it be? 4%, 3 or 4%. If it's, year over year up 14%, maybe it's 3 or 4% for the quarter. That amount of equity that's been added to everybody means that there's 800 billion more for homeowners in tappable equity. If you take the average homeowner, the data they had for this shows that the average homeowner has 151,000 in tappable equity. Leads into my question, what should you do as a homeowner? Should you do a cash out refinance? Does it make sense? And here's the thing, just like most things in mortgage, it's very scenario specific, based on your specific scenario. And not just that, but here's what I'll say about it. Here's, if you want a quick and dirty answer, here's my quick and dirty answer. It depends on what you're using the money for. If you're going to take 30,000 out in a cash out refinance and you're going to spend 20,000 of it in Vegas and the other 10,000 on fancy clothes, the answer is no. That sounds like a terrible idea to finance the Vegas trip and the fancy clothes over the next 15, 20, 30 years, whatever the term of your mortgage is. But if you choose to pay off high interest credit card debt with a cash out refinance, if you choose to invest in a business, invest in other real estate, things are going to provide a return, then I think a cash out refinance can make all the sense in the world and it can be great. A couple examples of conversations that I'm having with clients. Client reaches out to me, has a great interest rate on a 15-year fixed rate mortgage and says, I know that I have a ton of equity. This is the tappable equity that we're talking about. My wife has 100,000 in student loans that are 9% interest. Well, doing a little bit of rough math, because I'm a math guy, and talking through it with this client of mine, as she's making the payments on this 9% student loan, 75 to 77% of those payments are going towards principal. Every $1,000 that she pays towards that student loan, and that's on a 15-year term as well, only $230, $240 is going towards the principal, is paying it down. The other $770 is going towards interest. So if we do a cash out refinance on a 15-year term where we can get sub 2.5% interest rates for the mortgage and that debt that we're going to pay off, now all of a sudden we flip-flop that principal and interest equation. Now you've got 2/3 or 3/4 of your payments going towards the principal, paying down the balance, and only 1/3 of it or a fourth of it going towards interest. That's winning. That's good. Similarly, I've got clients that have a mountain of credit card debt, 50, 60, 70,000. And by doing a cash out refinance and paying off all that debt, they're going to save thousands. The caveat to this and the warning, to be straightforward with people, is if you do a cash out refinance, you touch this tappable equity, and you pay off all the credit card debt and you're down to zero, and then you go out and spend 50 or 60,000 on those same credit cards over the next 3 years, you're going to be in a worse position because now you owe more in your mortgage and you have that same credit card debt. But if you do, the opposite, and these cards are zero and you use them to spend $400 or $500 a month and then pay them off at the end of every month, you don't necessarily want to close them because that's going to hurt your credit, despite what Dave Ramsey says. But if you use them and pay them off and never pay any interest ever again because you're paying off the balance every month, and your mortgage payment plus all those debts paid off is probably $500, $600, $800 less than the payments you were making to those credit cards. If you now slap those extra payments onto this mortgage, you'll probably have that mortgage paid off in 8 to 10 years sooner. Or maybe you don't want to pay it off. Maybe you want to use the extra $600 or $800 to plop into a retirement account and build that up. Whatever you do, you're going to have choices. And in that regard, cash out refinance can be an amazing tool. Some people, because we've been in the pandemic, have learned, I want to remodel my house and create a home office. I want a home gym. I want to add a pool. I want to do an addition because we need an extra place where the kids can study if they're going to be doing some of their schooling at home, whatever the case may be, right? Some tappable equity can be pulled out and used for that. There's all kinds of different things. And it's so scenario specific that I can't just, use broad strokes to say it does make sense or it doesn't make sense. In past videos, I've talked about looking at your current rate versus the new rate. And in general, if you've got a 2.76% on a 30-year fixed, you don't want to do a cash out refinance to get $15,000 in cash and then have your rate go up to 3.15, because then you're pulling up the interest rate on all the debt you owe, including not just that $15,000 that you're going to go, pay off your car with or pay off some credit card debt with, but the other $285,000. So maybe in that case, you leave the 2.76 alone. But in a lot of cases where you can pull out $80,000, $100,000, you're starting a business, you're paying off student loans that are 9%, you're paying off, a lot of folks have these loans that they've used to do upgrades on their house, energy efficient upgrades that have 8%, 10% interest rates. Pay that stuff off. Take advantage of low interest rates. And I already hear the naysayers. We're adding to the balance. We're at risk of going into foreclosure. If you refinance and the payment on your refinance, when you do a cash out refinance and you've got a 30-year fixed payment and your payment's affordable, that doesn't seem very high risk to me. And the question I asked during this Black Knight question and answer that happened after their thing was, do we have some data to show 2021 versus 2008? Because I know what I'm going to hear is people are pulling money out of their houses. This is a bubble. People are overextending themselves. They're over leveraging themselves. Not even in the same stratosphere. People are in such a better equity position than they were back in 2008. They didn't have the exact data. They're going to bring that to me, but I can tell you with absolute certainty, when people were pulling out 100%, 105% of what the house was worth in 2006, 7, 8, and it was adjustable rate mortgages, that was risky. Now you're capped at 80 and it's a fixed rate term, not risky. So let me know what you think. I'd be happy to answer any questions. Just leave them down in the comments. If you're in California and I can help you, matt@mattthemortgageguy.com, shoot me a message. If you're outside of California and you want a great mortgage broker referral, go to greatmortgagebroker.com. Thanks for watching.